Welcome to This Explainer. Today, we're diving headfirst into one of the wildest economic stories unfolding right now. We are unpacking a massive collision between towering real-world physical infrastructure and, frankly, some pretty anxiety-inducing fears of a financial bubble. This is the trillion-dollar AI paradox that is absolutely driving the 2026 AI revolution. It's a fascinating story of heavy machinery, sky-high debt, and the future of computing. Let's get right into it.
Okay, so let's unpack this massive paradox. On one hand, you've got this highly tangible, multi-billion-dollar fiscal reality taking place right now. Take South Korea, for example. They are pouring $14.5 billion into actual brick-and-mortar factories just to build AI chips. But then, you look at the other side of the ledger, the speculative reality. AI software startups are projecting some truly staggering financial craters. I mean, OpenAI alone is projected to hit annual operating losses of an eye-watering $74 billion by 2028. They're spending a fortune on infrastructure, but haven't really presented a clear roadmap to profitability yet. So, how on earth do these two totally different realities coexist?
Well, to grasp the sheer unbelievable scale of the boom we're talking about, you really don't have to look any further than the hardware giant NVIDIA. By October 2026, NVIDIA completely shattered market records, officially becoming the world's first $5 trillion company. I want you to just let that number sink in for a second. $5 trillion. If NVIDIA were a country, it would literally be the third largest economy on the planet, right behind the US and China. Their explosive growth, quadrupling since 2023, was the undisputed engine behind the stock market's record highs, accounting for roughly 80% of all gains in the American stock market over the year.
Section 1. Breaking the memory wall. The physical limits of AI.
But here is the catch. That monumental $5 trillion valuation rests entirely on the continued demand for physical hardware. And right now, the whole AI industry is slamming into something called the memory wall. Now, this isn't some abstract financial concept. It's a hard physical limit. It's a phenomenon where data transfer speeds from memory simply cannot keep pace with the massive, ultra-fast computation speeds of modern AI chips. When the processor has to sit around waiting for data, performance just tanks. It honestly doesn't matter how fast NVIDIA's logic chips are if the memory can't feed them data fast enough. So to smash through this wall, the industry is heavily relying on high-bandwidth memory, or HBM, which stacks thousands of microscopic data transfer channels right on top of each other.
And this is causing a really fascinating shift in global manufacturing power. Because to build that insanely complex high-bandwidth memory, chipmakers desperately need extreme ultraviolet, or EUV equipment, from a Dutch company called ASML. Look at this shift. For the very first time in 8 years, memory manufacturers have actually overtaken logic chip makers like TSMC in ASML's first quarter net equipment sales. We are talking 51% of sales for memory versus 49% for logic. The memory makers are taking the reins here because breaking that memory wall is absolutely the #1 priority for the entire AI revolution.
So who is actually buying up all this highly specialized equipment? South Korea. Tech giant Samsung and SK Hynix are aggressively sweeping up the global supply of these machines. Get this, out of the 60 low-NA EUV systems ASML expects to ship this year, around 40 of them are heading straight to Korea. These two companies are pouring roughly 20 trillion won, which is about $14.5 billion into these preemptive investments. They're building massive expansions in places like Pyeongtaek and Cheongju with one specific goal: to manufacture the high-bandwidth memory that the global AI industry desperately needs to function. And trust me, they are paying an absolute premium to do it.
Section 2. The circular investment loop. Artificially inflated?
Now, these next-generation memory chips and processors are, as you'd guess, incredibly expensive. Which brings us to a vital question. How are unprofitable software companies actually paying for all this hardware? Well, it perfectly illustrates what critics are calling the circular funding loop, and it's a structure that definitely has analysts raising their eyebrows. Here is how it works. Step 1, hardware giants, like NVIDIA, pour billions of dollars in investments into AI software startups. Step 2, those very same startups take that freshly invested cash and use it to buy billions of dollars in hardware, right back from NVIDIA and its competitors. Step 3, this circular flow of money drives up revenues for the hardware makers, which then inflates the valuations of the startups. Critics argue this cycle might be artificially pumping up the entire sector, kind of masking the fact that the end product software isn't actually generating enough organic profit yet. So if the software isn't paying for it, who is?
Section 3. Expensive debt meets AI. Funding the AI boom. To answer that, we have to look at the 10-year U.S. Treasury yield. That's basically the absolute benchmark for global borrowing. As of mid-2026, it's sitting at a pretty restrictive 4.55%. That is well above the post-2008 norm we all grew so used to over the last decade. This percentage essentially sets the price of money globally. So when this rate is high, borrowing the billions of dollars needed to build massive AI data centers becomes incredibly expensive.
And here is the crucial, somewhat scary point. Despite these high borrowing costs, the debt being taken on to build AI infrastructure is absolutely exploding. Analysts at Morgan Stanley estimate that data center debt is ballooning toward $1 trillion by the year 2028. $1 trillion! But what's really got financial watchdogs sweating is the actual quality of that debt. A worrying amount of these data center bonds are holding BBB ratings, or even worse, they're rated as absolute junk. We are essentially funding a highly experimental technological revolution with a massive mountain of high-interest, high-risk debt.
Section 4. Dot-com Bubble 2.0. Echoes of the 2000s. When you mix junk-rated debt, huge software on profitability, and those circular funding loops, it sparks a fierce global debate. Are we repeating the catastrophic tech crashes of the early 2000s? Let's look neutrally at both sides of this. On one hand, the bubble fears are entirely real. Institutions like the Bank of England and the International Monetary Fund are warning of a sharp market correction. They point to extreme valuations, noting that the Shiller price-to-earnings ratio for the U.S. market has topped 40 for the first time since the dot-com crash. To them, the deep operating losses and that circular funding loop are massive, glaring red flags. But on the flip side, the boom defenders, places like Goldman Sachs, Morgan Stanley, and even Fed Chair Jerome Powell, argue that this is absolutely not the year 2000. They point out that this boom is backed by real enterprise revenue, that top firms have cash reserves 3 times higher than during past bubbles, and that AI is genuinely integrating into the real economy, driving actual productivity.
For a little context on how the broader market is reacting to all this uncertainty, it's really fascinating to step outside of tech for a second. While analysts fiercely debate AI's bubble status, huge amounts of capital are seeking safer, heavier shores. Look at other capital-heavy sectors, specifically defense and shipbuilding. They are seeing what analysts call unprecedented booms right now, with no end in sight. Investors are flocking there because, unlike AI software, those industries offer steady, highly visible order flows, high pricing due to shipyard shortages, and incredibly strong earnings momentum. It's just a stark contrast to witness, the highly speculative, debt-fueled frontier of AI sitting right next to the tangible, order-backed reality of heavy manufacturing.
Section 5. The final verdict. Reality versus speculation.
So, taking all this data in, the massive factory builds in Korea, the circular loops in Silicon Valley, that looming $1 trillion of debt, what should you actually take away from all this? I think JP Morgan CEO Jamie Dimon hit the nail on the head when summarizing the historical reality of technological revolutions. He states that the technology itself is absolutely real, and it will change the world. However, he warns that just like the invention of the automobile and the television, which undeniably changed society forever, most of the early companies and investors involved in them ended up failing. The technology will absolutely pay off for the world, but early investors can still easily lose their shirts in the turbulent process of figuring out who the ultimate winners will be.
As billions of dollars continue pouring into South Korean memory factories, and as literal mountains of junk-rated debt pile up to build AI data centers all across the globe, we want to leave you with this final, provocative thought to consider. Look at the immense scale of this endeavor and ask yourself, are we fundamentally building the infrastructure of the future, or are we just funding the world's most expensive circular financial loop? Thanks so much for joining us for this explainer, and as always, keep questioning the data.